Hey trader, ever feel like you are always one step behind the market? What if I told you there is a strategy that top traders and even institutions quietly rely on? And you have probably never heard of it or you don't use it at all. It's called candle range theory. And today I'm going to show you how to use it across the 1 hour time frame and move on to 15-minute time frame and use the 5-minute chart to predict the next move before it happens. This is not fluff. It's precision trading with a trading view. That's the platform we're gonna use, and let's get into it. But before anything, I wanna remind you something that I find really basic but very important. It's a concept in microeconomy, right? So let's say, for example, we have a system, right? A system of axis, okay, like this one here. We have in the y-axis, we have P, that's price, and the x-axis, we have Q, that's quantity. Okay, so we have a positive correlation, right? Going up, that we will call quantity supply. Okay, and we have a negative correlation. This is the quantity demanded. Okay, so now when we are talking about the market, everything is about buyers and sellers. We need both in order to make any transaction go through, right? So right here, we have the supply and demand. When we are trading, that's what we are talking about too. We need sellers and the buyers. So this concept, that what make this concept crucial for everything. So if you understand this concept, it will help you a lot, because when we talk about demand and or support and resistance, the basic is this. So here, for example, if we want to find the equilibrium price, we have to come to this point here. This is the equilibrium. So let's say, for example, if we project this line to this one here with a discontinued line, the y-axis price, we will have here the price at the equilibrium. This is the price at the equilibrium. So how can we get the price, this price at the equilibrium? Is projecting this to the quantity x. So at this point here, we will have quantity demanded equal to quantity supply. Okay? So this is a system of equation, like having, let's say, quantity demanded equal, let's say 50 minus P. P is the price. Q is the quantity. It doesn't matter. It can be any asset here. This can be, let's say, for example, this is Apple, or this is Microsoft, Amazon, Tesla, or whatever, any asset. And the quantity supply will be, let's say, 25 plus, let's say, 4P. Okay, so now here we have a system of equation, right? So now if we say the quantity demanded equals quantity supply, so we can solve this equation. We're gonna have a 50 minus P equals 25 minus plus 4P. So if we regroup all these things here, we're gonna have like 50 minus 25 equals to 4P plus P. Okay, so we will have 25, let's say 25 equals to 5P. That implies P equals $5. So this P over here is the price at the equilibrium. So now, whatever you have below this price at the equilibrium as considered as the price at discount price. Whatever you have above PE, the price at the equilibrium, is called premium price. You are paying the asset at a premium. This is our chart here. If we are, when we are trading, we have the price in one side and we have the volume, the timing, everything that you know, in price action. So now let's go back now to our class for today is about candle range theory. Okay. So before we start, I'm gonna remind you something that we saw in the previous video about the candle. Okay. Let's say, for example, that we have this candle here. Okay. Let's say it's a bearish candle. So right now here we have the wick for this candle here and here. So at the opening price, we have the opening price here. This is opening price, and this price, this candle open its price here and close the price here. Okay, here we have the lower price, and this is the highest price, right? The highest point price travel to. So now this point here, from here, we have, let's say, we have this is the candle range high, this point here, and down here we have the candle range low, right? So now from here we have said that this is the range. This one here, the point from there to here is considered as the range of this candle, right? So now, if we make another line here and another one here, we can say that when the market open, you're gonna see something like this, and then it come to the highest point there, come back here, and do things like this. This is the way how this candle behave, okay? And then right here we have what we call A. This is the accumulation, and this is the manipulation here, and the distribution here. And this happen in different markets. In Asia, for example, let's say in Asia, if they have the accumulation in the session of Asia, they have the manipulation in London when London is open, and distribution in New York when the NYSE open. Okay, so now what is the psychology behind the CRT? You know, every candle that we have, that we see in a chart, let's say, for example, this chart that we have over here, every candle we are seeing here in this chart represent a range. Reason why we have to remember always that a run in a higher time frame is a trend in a lower time frame. And we have the timing here, okay? When you are dealing with the monthly, you can combine it with the daily, the weekly with 4 hours, 4 hours with 15 minutes, 1 hour with 15 minutes, 5 minutes. It depends on how you want to combine this timing. And the other things is that because every candle represents a range here, the range can be swept, it can be retest, it can be broken out. So now let's see this in a graphic. We have seen already that the market moves in 3 phases: accumulation, manipulation, and the distribution. So now, how can we use the candle range theory, and how can we set up the theory so we can use it? So let's say, for example, that we have this bearish candle, right, with its corresponding shadow or wick. Okay, the first things that we have when we have the candle here, let's say we are in 1 hour time frame, in the 1 hour time frame. Okay, so we come here, let's say we have this is our candle range high. And we have the low here. We have the candle range low. Okay, write this one here, like let's say it's 1 hour candle. We can specify the timing at let's say 9 p.m. 9 a.m. Okay, 9 a.m. sharp. Okay, at 9 a.m. sharp. And this one here, it's duplicate this, and we put it here. This is our 1 hour time frame candle, right? So the first things that we have to do here is to set up the range with these highs, high and low. And then the second one, let's say that we have another candle here. Okay, we have another candle here with its corresponding weeks. We have this one here, and we have another week here. Sorry. So this one here, as you can see, this candle has a, but it's weak. It is longer than the first candle wick. So it penetrates here the liquidity of the first candle. So the second candle grabs the liquidity of the first candle. Okay, let's name this one here as the first candle, and this one here is the second candle. This one here is the second candle. Okay, so the second candle grabs the liquidity of the first candle. Okay, so now let's say that we have a third candle here. We have a third candle here. And this candle with its corresponding shadow, what this candle did, this candle just breaks out of this range that we have here, the 1 hour range. Okay, so as you can see in this structure that we have here, this one here is the candle range high. Okay, and this one here is the candle range low, right? So in this one here, we have the first one here is the accumulation, and it is set the candle range high and the candle range low. The second one is the manipulation, okay, because it grabs the liquidity from the first candle. And the third candle, what it did, it breaks out of the range, closing above this candle range high here. Okay, so now it doesn't mean that this is the only structure that we can have. You can have so many other candles between this range in terms of manipulation before you get the breaks out candle. Okay, so now, and this one here, the manipulation most of the time, because if this candle here is the first candle that was printed at 9 a.m., the second candle will be at 10 a.m. Okay, so what we have to do is when we mark the first candle, we're gonna move the 15-minute time frame. At the 15-minute time frame, we're gonna mark this candle here. Let's say the manipulation here, the second candle that will open, we're gonna mark that one. Its range is gonna be like this one is gonna be 15 minutes. 15 minutes. Okay, 15 minutes. Let me write here 15 minutes. This gonna be the 15 minute, and this gonna be the 15 minute. 15 minutes. Okay, so now after we do that, now we can move to the 5-minute time frame for our entry. This is the process that we have to follow. Now we're gonna try to do all what I just explained here using the chart. Okay, so now let's come here to this chart. Okay, The chart that you are seeing here is the Palantir stack. Okay, as you can see here is the PLTR for our experiment. We're gonna use the replay. Okay, we're gonna remove these candles here and start with this candle here. Okay, as you can see here, this is a bearish candle, right? So this candle, as you can see on the y-axis, that was April 14, 2025 at 9:30. The market opened here in New York at 9:30, right? So this candle here has a duration of 1 hour. All the candles that you see here in the chart has a duration of 1 hour. So now, the first step, what we have to do is to mark the high here, mean the candle range high, okay, and the candle range low, okay. And let us specify this. Let's put a letter here. This one is gonna be 1 hour candle at 9:30, right? At 9:30 a.m. Okay. And this one here, let's copy this and have it here. I'm just doing this because I want you to see it in a way, in a clear way. Okay. So now, when we do this, the second step, because the first step here is about setting up the range with high and low, and that's what we have done here. So now from here, we're gonna move to the 15-minute time frame. Okay, so let's do that. So you see now here, I have 4 candles. Why 4 candles? Because we move from one candle with 1 hour duration to 15-minute candles duration, right? So we will have 4 candles. 4 times 15 is gonna give us 1 hour. So we have 4 candles here. Okay, so now we have to wait the next candle to print at 10:30, right? So let's play this here to see. Okay, we have it. We have it. We have the first candle here. This candle here, as you can see down there at the x-axis, was printed at 10:30 after the phase of the previous 1 hour, right? This one open here. For this, we're gonna mark that one too. Okay, we're gonna put the high of this candle here and its low, the low of the candle. Okay, the low of the candle. Okay, so as you can see here, we have the second candle that was printed inside. Let me write here. This is 15. Okay, that's a 15-minute candle. Okay, this is the 15-minute candle here. Okay, this is the 15-minute candle, and this one here, we have this one here, and we have this one here. Okay, so the first candle, I have another bullish candle here, a small bullish candle that was printed inside here. Okay, but it closed inside the range of the 15-minute candle, but it had grabbed already the liquidity of this candle, the first candle that was printed. So now we have, let play out to see. Okay, we have this candle here, and as you can see here, this candle here, it closed inside the range of 15 minutes. And one possibility could be to go higher or to retest the lower range over here. Okay, so let's see what's gonna, because we are waiting for the candle that can grabs the liquidity of the first hour candle, right? So let's see. Okay. As you can see here, this candle here, the third red candle, sell candle here, this one, the doji candle, it's with a very small body here and a long wick in high and low. Grab the liquidity of the first hour candle here, the first candle. Okay, remember that we said that the first candle defined the range, right? And the range of the first candle was this one here, between this one here and here. So the next phase, the next candle will grab the liquidity, and this one here grab the liquidity. Okay, it grabbed the liquidity here. So now it grab the liquidity. So now we can move to the 5-minute for our entry. Okay, that will give us the precision. Okay, let's go to the 5-minute chart. Okay, so as you can see here, now we have a retracement here. It grabbed the liquidity, and also the first candle here, this candle here, the bearish candle, break out the range. Okay, so what we are looking for our entry now. This candle here, we have the second candle here is this is a bearish engulfing. This bearish candle is engulfing this one here. Let's print out this one, the second candle, to see what we can get from that one. Okay, so now right here we have this candle here. We're gonna place our entry on this candle here. We have this one here. We're gonna put okay, we have this one here. Now we're gonna go long because we have already the first bullish candle here. Okay, market is about to go up. Okay, so now I come here, I take the long, place it here. Okay, so now what I can do is, as always, I like to use the ATR. I have it here, and because it give me measure the volatility. Okay, and I have it here at the red. It 81, 83. If I multiply that by 2, it's going to be 81, 88, 0.8188 times 2 is going to give me 1.64. Okay, I come here, I measure that, it's 1.64. Okay, just right here. Okay, this is going to be my stop loss. The stop loss is going to be like amount is $750, something like that. That's what I am sacrificing in order to get what? Twice of that. So it's going to be twice. So it's going to give me 3.28. 3.28. I'm going to put this like 3.28 is going to be 3.28. Or other things that you can do is just to take the Fibonacci here. Let's say, for example, this is going to give you the 50%. 50% of the middle, the middle. You can, your first target can be at the 50%, right? Or if you want to take more risk, you just take it always to the level of the range, okay? And you do this, and then what we're gonna do is we have this now. So let's play it to see what we're gonna get. Okay, so here you go. Let's. Ooh, okay. We hit it. Yep. So this is what this strategy is about. And what I will recommend you to do is to backtest it, to practice, and check it out to see if it can help you to improve your win rate, because I have been using it And it's cool. It's cool. And there is a science behind it. So, just to recap about what we have seen about it, the first thing is we have to set up the three candle. The higher time frame gonna give us the structure, and the lower time frame gonna give us the confirmation. And remember that CRT is not about prediction. CRT, it's about following the blueprint left by big money. Reason why you have the three candles, right? The first one help you to set up the range with high and low. The second, we grab the liquidity from the first one. And the third one will break out of the range. And from there, you can look out for your entry in the 5 minute time frame. And as I say, I will really encourage you to backtest CRT. If you don't have a trading view, you can look at another platform that can allow you to backtest. And if you have found value from this video, please like it, comment, and subscribe for more institutional level breakdown. Thank you for watching. Until the next video. Bye.